Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for December 7th, 2020. Please see our disclaimer for important information. And here's our COVID tracker for the week. As you can see, scrolling from left to right, the 7-day moving average for both daily new cases as well as daily deaths. We are entering that second week following Thanksgiving Day weekend, and that was something that we were watching heading into the holiday season as what was that number going to look like. Now, the good news is that we've seen an attenuation in daily new cases, kind of is really almost from the beginning of I'd say, well, certainly the beginning of December, but even heading into the Thanksgiving Day weekend, we were seeing a drop off in the 7-day moving average for new cases. And we saw a little bit of a dip on daily new deaths, and that number has kind of picked up slightly in both cases, just literally here in the last handful of days. So obviously heading into this next week, which is kind of that 2-week draw forward from the Thanksgiving Day weekend, we'll be very interested to see what happens to these numbers if they continue to tick up or if they kind of flatline, which we certainly do hope. Here's our chart of inpatient hospital bed utilization, and this is by state, so it's a little bit busy because it does list the states individually, and you can see that there's a 10-year average of hospital utilization through 2017 that's just under 70%. And the national average as of the end of last month was right at 70%. And you can see as you scroll towards the right that there are clearly some areas, including Texas, that are above that average. And then those are offset by some of the areas if you look out, some of those are out west, and then Vermont is in there too, that are below the trend. But clearly it's kind of a mixed bag, and I can, just say that, at least that data that we saw in the COVID tracker in the previous slide, the pandemic and the rate of infections is not as regionalized as it was. It's fairly widespread now. But good news is that really, except for just a small handful of places, that were not in a critical situation with regard to hospital utilization. Here's our COVID case fatality rate. Now, this is not the aggregate number. This is a rate. So as you can see here, that line is calculated by taking a weekly deaths divided by positive cases at a 2-week lag. And so that number continues to trend down. And so, this number probably doesn't get as much headline activity in the press as does the new daily case number, which is clearly alarming in its own right. But the good news is that the death rate is going down. And this is another chart from the CDC that we've shown on occasion just to kind of give you some perspective. And if you really, if you look at this chart, we're really talking about over 80% of the population, or excuse me, 80% of the COVID-19 deaths dating from beginning of February through the end of last month attributable to that cohort that lies above the 55-year-old age cohort, that the younger generations just literally don't account for very much of the overall deaths, even though they account for a fairly meaningful percent of the population. So this is something that we continue to update. The numbers haven't changed a whole lot over the last couple of months, but I thought I'd go ahead and include it here to update you. Got a couple of charts on the vaccination process, and this is the one that seems to have gotten the most publicity, even though there are 3 therapies, 2 which have been applied, or excuse me, 2 that have applied for emergency use authorization, or EUA. This is one of them. This is the Pfizer BioNTech vaccination, and a lot of questions. Actually, I was curious about this myself last week. And so really you take a dose on day 1 and your second dose is 2 weeks henceforth. So day 21 would be your second dose. And then by day 28, you'd have full immunity. And of course, there's other attendant issues with this particular therapy. And it has to do with transportation at ultra cold temperatures, and the Moderna and AstraZeneca's don't seem to have that same issue. But obviously, this is something that we'll come to understand much greater as these vaccines are beginning to be distributed out into the general public. And we know that the first recipients are going to be the frontline first responders, nursing home employees, and general caregivers before the general public gets these. Another question I had was what was going to be the cost of these. We've had tremendous and unprecedented development of these drugs, and this includes at least the two, including the Pfizer and BioNTech therapies. As you can see here, that is going to cost about $20 per dose. The Moderna, which is another one of those three, and one of those that's applied for a EUA authorization, that's a little bit more. But again, I think it was speculated that some of these might be upwards of $200-300 a dose, and that's just not going to be the case. This one I saw on a Twitter feed, and it just kind of gives you a global perspective as you look essentially over a 2-year window, and is just looking back from 2019 and then drawing that forward 2 years to say at the end of 2021, how many economies across the globe are going to be greater or less than they were at the end of over that 2-year stretch. How many economies across the world will actually grow relative to the year end last year. And so you can see really, those are highlighted in blue. So you've got Indonesia, China, Russia, then you've got the Nordic countries. But other than that, a lot of the other developed and in some cases emerging market countries, South America, North America, and certainly Western Europe are actually going to be below where they were at the end of last year, even still. We've got some other GDP charts to show you, but this is kind of a 1,000 words in a chart here just to show you that there's going to be a lot of economies around the globe that are still going to be below their aggregate economic output level at the end of next year relative to 2 years prior. Here's our high frequency data from First Trust, and again, this is looking at data as of 12/3, and so it does capture in some cases a lot of the data from the Thanksgiving Day weekend. We know that there were a lot of people traveling. There was a fair amount of mobility, but ironically, it's not really captured in these statistics. The 7-day moving average of TSA checkpoints down fairly significantly, even though for the month it's up. Motor gasoline supply is down. We've seen kind of a little bit of a retrenchment in a lot of areas that we'll have to monitor heading into the last month of the year. But basically, a lot of the high frequency data is just kind of softened up, even if the labor market has continued to kind of track in a positive direction. Something I came across from the American Psychological Association, this was in a Daily Shot publication, but it really kind of made me think about the youngest generation out there, the Generation Z folks, and what has this pandemic done to them. And you can see in the upper half of this, you've got Gen Z adults, average reported stress level over the last month, and you can see going from 2018 to 2019 that number was increasing already, and then 2020 it continues to go up, and that number's even ticked up a little bit when you look at the overall average. So we know that there's been stress in the small business sector with employment, et cetera, and that would intuitively have an impact on this youngest generation. But what's really kind of profound down here below is the is the charts that, planning for their future and then disruption of plans to their future. And a fairly high percent of those Gen Z teens have reported this impact. And these are the ones that are that are being impacted by remote schooling and things like that. So it's pretty interesting to see the impact on these folks, and it's going to be interesting to gauge the psychological influence of what's gone on here in the last year in terms of education delivery, on that cohort. We'll talk about GDP for a second. This comes to us from the Federal Reserve Bank of San Francisco and the BEA, the Bureau of Economic Analysis, and it shows you this trend line in real GDP. This is an annualized number, so it's smoothed out a little bit, and you can see the 2020 dip with the coronavirus manufactured shutdowns. The green line represents that trend line that kind of continues out that multi-year trend. And then the dotted line represents from the point of where we are right now of having recovered a lot of that big dip earlier this year, but we're still quite a bit below that trend line. And as you can see, this particular iteration actually doesn't show us reattaining that trend line in at least the next 2 to 3 years. But it does show us at least by the end of next year getting closer to that point of aggregate economic output, which is, it was just over $19 trillion at the beginning of this year. It shows us taking to about the end of next year to kind of get back to that point. Something I wanted to show from the Beige Book, and this is from the Federal Reserve, and they have 12 reporting districts for the Federal Reserve, and each district has an assessment of their economic conditions. And the good news here, and the reason I wanted to show it, is represented at the far right, and you've got those two blue bars that are above zero after significant negative reports for multiple periods. We've had some consecutive positive reports out of the various Fed districts, and I think that's very good from a sentiment standpoint, from a business opportunity standpoint. Even though we've got a lot of stress in the small business sector, I think overall this lays the foundation for positive growth next year. There's a lot that goes into these numbers. Supply of credit, logistics, inventory levels, demand indications on the part of clients. There's a lot of indicators that go into these numbers, so it's good to see them positive. I took a quick look here at global manufacturing. This is not global trade, which we know has been weak, but it's global manufacturing. And even though we've kind of we've hit that interim peak and we've kind of rolled over slightly, the numbers are still positive. This, the solid line is what I'd want you, a solid black line rather, is what I'd want you to focus on. That's the global number. We've got Taiwan and Japan also in this chart, and they've trended the same way. But the good news is that from a global manufacturing purchasing manager index standpoint, that number is not only positive, but it continues to trend up. Kind of continuing on the heavy industry theme, good news is that we've seen a fairly strong rebound. We've talked about this in some charts, even if it hasn't, even if it wasn't represented in the high frequency data. But overall, this year we've had a strong response from the shipping and the freight industry here domestically, and as a result, you can see in this particular chart a rather stout rebound in Class 8 truck orders, and these are the vehicles required to transport that freight on an overland basis. Again, this isn't rail, it's certainly not seaborne freight, but this is overland trucking and new truck orders. This is a leading indicator for economic growth, and you can see that we're reattaining that prior peak from 2018. So I consider this to be a fairly good sign for us heading into next year. Quick look at unemployment. We know that as a lot of the regular employment benefits begin to wane for a lot of the people that filed earlier this year, that there's an increasing amount of applications for the pandemic unemployment assistance, the PUA, and then the emergency unemployment compensation index, which is, these tend to cater more towards maybe the self-employed and then the self-reported unemployed folks, as opposed to those who have traditional W-2 jobs with employers that are paying unemployment insurance. Bankruptcy filings, the light number, and if you want to take away something positive, at least for the time being, you can look at this chart. But bankruptcy filings in 2020 are down reasonably from a year ago. And why might you expect that to be the case in the midst of a pandemic with an economic shutdown? Well, the simple fact is that we've had a lot of forbearances. We've had a lot of, this has a lot to do with, and these aren't necessarily business bankruptcy. This is, includes personal bankruptcy. Personal filings are down, really, as the headline says, because there are forbearances and moratoriums on evictions and things like that. Now, the flip side of the coin here is that a lot of those forbearances and moratoriums expire at the end of this month. So if they are not extended and we don't have a bill, and we'll talk about that in a little bit, what's being considered now by the negotiators in Congress that are kind of working, together to try to come up with a compromise bill. If we don't see that, then this number most certainly will go up because of the things that are expiring at the end of this month. Household debt service, and along the same theme, because there have been so much assistance and fiscal stimulus that's been put into the system that, ironically, and this is not everyone, but the lower socioeconomic levels, the money that was received was spent, and we saw spending numbers be influenced by the lower socioeconomic levels. Now, at the higher socioeconomic levels, which represents also a fairly strong aggregate number of debt service per capita, you've seen a lot of people use that money to pay off debt and credit cards and things like that, and that's influencing this particular chart here, which shows that those numbers have gone down this year. So the household, by and large, was heading in the right direction as we were entering the pandemic. Businesses were going the opposite direction, increasing their debt level, increasing their leverage. But as you can see here, just on balance, household debt service as a percent of disposable income continues to trend down. So this is from B Politics. This is on the, I guess, as you look at these different categories on the left, and then those two columns on the right, the one on the left represents what's being discussed by this bipartisan gathering of legislators. And without going into every line item, you could see that there's money. There's a lot of different money. There's state and local government aid. There's certainly an extension, an increase in the PUA benefits, that pandemic unemployment benefits that we just got through talking about. Very positive. Small business help, we desperately need that. Individual stimulus checks are not being considered in this one. So that had been on the table for some proposals, but not this one. But you can see, there's money for airlines, there's education, more vaccine dollars, as well as child care and hospital aid. So there's a lot of money available. Not too many people understand where these negotiations are. Not too many people really have their arms around what kind of dollars are being discussed right now. So this is hopefully a little helpful for you to understand. All right, we'll get through some economic charts here in fairly short order. Now, this is your mortgage rate. So even as we've seen a bit of a pickup in the 10-year U.S. Treasury rate, we continue to see 30-year fixed mortgage rates continue to trend down. That's a positive sign, good for homeowners. home buyers, I should say, certainly homeowners that want to refinance, and helps the overall housing affordability question. As a result of low mortgage rates, you can see that mortgage purchase applications are trending up, not too surprisingly. Again, kind of further evidence of the health in the housing sector. Quick comment on inflation. So this is from the Federal Reserve Bank of San Francisco. And this is, I wanted to show this because this is, I can give you my thoughts on inflation. I do think there's a long-term uptick in inflation, and that is corroborated here in the Federal Reserve study, which also lays on top of the BEA numbers. But, it's not going to come overnight. It's probably going to take really a couple of years to kind of manifest, and it's actually going to take a while for us to kind of hit that 2% Fed target. So what this really indicates to me is that you're going to have low short-term rates for a very extended time until that number ticks up over that longer run target. But here in the near term, I'd certainly would expect higher inflation in 2021 than we saw this year, and higher inflation in 2022 than even 2021. Here's the Institute for Supply Management Services PMI index for prices. So, again, on this theme of inflation, this is prices at the production level for the commercial sector. These aren't consumer prices, but you can see that prices in the channel of production are going up. And that's an interesting development here amidst this pandemic. So, as it relates to pricing power of companies, now it's very hard because you've got a lot of depressed consumers that want to spend a lot, but in some cases don't have as much of the means to do so. But the internal costs for production are going up, so it's going to put some pressure on these producers to increase their prices to the end customer at some point, and we'll just have to wait and see whether they're able to actually do that. And if they are, then that would certainly contribute to continued upticks in the consumer price index. The 5-year TIPS yield. So what this basically tells you is that the 5-year Treasury rate minus inflation. Now we know the 5-year Treasury rate hasn't moved a whole lot. The 10 years kind of meandered up closer to 1%. The 5 years definitely below that, but this TIPS yield kind of shows you what that 5-year Treasury rate minus the rate of inflation is. And so what I'd take away from this chart is the fact that it's trending down even further into negative territory, kind of retouching those lows that we saw back in September, is an indication that there is more inflation expectation built in to the market right now. And low real yields. This is a 2-year real yield, and the U.S. real yield is negative 1% right now, which it just means it's the 2-year Treasury yield minus the rate of inflation. And so that number is, even as inflation picks up, and interest rates don't move on the short end of the curve, that number is going to continue to get negative. And as you can see, outside of Norway, I mean, we're as low in real yields as it gets. And I do agree with this study by Alpine Micro that it's going to be bearish for the dollar, which would imply a weaker dollar, which in a twist of fate would be positive for exports being cheaper abroad. Certainly would be better for commodities, for things like gold and energy, things that are denominated in dollars. So just an interesting dynamic here. And there is your U.S. dollar. This is the spot index. This is against a basket of currencies, or what they call the DXY, if you will. Dollar continues to trend down this year, in large part because of the negative real yield situation that we just discussed. Here's a chart of the 10-year to 2-year government bond spread. And so this is basically taking the 10-year Treasury yield and subtracting the 2-year Treasury yield to that. And you can see that that number has been going up ever since the summer a year ago. And it flattened out for a while. There was a big dislocation when we had the economic shutdown earlier this year. But as you can see here, what this indicates is the yield curve, going from short on the left hand to long rates on the right hand side. That curve continues to steepen a little bit. And the ramifications of this are multifold. One, it will eventually translate into higher mortgage rates. If you have higher, longer term yields. And we know the short term yields are going to be pegged because the Fed has told us that short term rates are going to stay low to even extremely low, near zero for a while. And we know that there's not enough inflation pressure in the pipeline to make them change their feelings on that. But as longer term rates go up, it's going to do a couple things. One, it's going to help financial firms, banks that lend off of the spread, if you will, that it's going to help their financial condition. And it's also going to impact the housing market because eventually it's going to put upward pressure on mortgage rates. And here is that 10-year yield right now. And this tracks basically from the beginning of the year. So as you can see, we started the year and we were about 1.9 and we were approaching 2%. We rolled over a little bit and kind of consolidated a bit heading into the pandemic, and then obviously with the emergency rate cuts and whatnot, and the economic decline, we've retrenched. But you could see that near-term trend dating back to really kind of the height of that second wave of infections in late summer, that we've kind of slowly meandered in a trend line up closer to 1%. We're going to talk about some market dynamics now, moving away from economics, if you will, and here's something I wanted to show. This is kind of an indication of what I would consider to be a little bit of froth in the high yield and the speculative grade fixed income markets. This is the corporate high yield yield to worst number, and you can see that number continues to trend down. And why is that important? What it shows you is that a higher rate of a yield would indicate that investors are pricing in more risk into those issues. And these are bonds that are speculative grade, and it even applies to low rated bonds that are not investment grade at all. And even those yields are way down at essentially a decade low here. And it just shows you that there's a lot of interest in buying yield when we're sitting in a low yielding environment. And it indicates to me that there's a little bit of froth in the market. A couple of equity-related indicators are the call option volume and the put-call ratio. And without getting too technical, basically the fact that you've got a call option volume number that's really spiking means that there are a lot of speculators speculating on the continued growth of the equity market. They're betting on the come. They're betting that the market's going to continue to go up. There are a lot of liquidity flowing into this, and this is the strong indicator here. Put call ratio, the fact that this is so low means that there are obviously many more people that feel like the market's going to go up than it's going to go down. And so the speculative bets are being placed to try to hedge to profit on the upside of the market. Again, this is another indication that maybe the market's a little bit ahead of itself. This is a Citigroup panic euphoria index that I've watched from afar for quite some time, and they're very good at this number. And so what this shows here is that the indicators, and there's a lot of different things that go into this, a multitude of factors. And right now the factors are pointing to really a kind of a state of Euphoria. And as you look back on this chart, I think it's helpful to have the 12-month forward return numbers in that grayish line, or the grayish area, kind of plotted against this, because you could see that there's a reasonable amount of negative correlation. And why is that important? Because if you assume that that Euphoria, the sentiment here is in euphoric territory, that your implication is that your forward 12-month forward return is not going to be as robust. This is a number from Alpine Macro, and I just wanted to give you some multi-year historical context for what S&P forward earnings per share look like. We talk about earnings multiples and stuff a lot. This is actually evidence of what those actual forward earnings per share numbers look like. And so you can see that there's a fairly reasonable trend line of those earnings, and they've dropped off a cliff in 2020. We know that because of economic slowdown, so on and so forth. And that number's come back. The third quarter earnings that we got, that it literally just concluded several weeks ago, were positive. They're a nice bounce back, but you could see that red dotted line up at the top represents the gap between where we are and what that multi-year trend line looks like. So we're still way below that. We're about $160 a share in index earnings. And then if you go down to the bottom, that shows you what that forward 12-month PE, or price to earnings ratio, looks like. And this is what I've been saying. There's a little bit of froth in the market that price to earnings multiples are higher. They've come down a little bit with this bounce back in third quarter earnings. But if we were at trend line, the valuations in the market would clearly be above where they were last year, even still. Even so that, in other words, if we were at the same level of earnings that we were last year, if that dotted line on the top got us back up to that solid black line, that the valuation in the market would still be about 19 times, which would be higher than at any point, at least in the last 5 years. So again, another kind of thought here that even though we've bounced back in earnings, that it's still going to take a lot of earnings to kind of to help us get back to a more reasonable price to earnings multiple. And yet one more indicator on the S&P 500 valuation level. This is a 10-year cyclically adjusted price to earnings ratio, or CAPE ratio. And this is a rolling 10-year average. And what this shows you is that here, as we head into 2021, that we're at a level that we haven't seen since the end of last century during the tech bubble. And we kind of touched on this a little bit. We touched this level about a year ago, and then then we had a little bit of a sell-off, and then of course we had the pandemic this year. But all told, if you take that 10-year CAPE ratio, we're back up to the level that honestly we haven't seen for quite some time. I'm going to go ahead and conclude here with a couple of charts that I thought were interesting. I always try to end the broadcast with at least a couple of general kind of non-financial interest, and this is one that kind of caught my eye. Obviously Netflix has been around for quite some time, as has Hulu, and Amazon Prime came into its own about 5 years ago, and you could see the subscriber growth in those platforms, and you can kind of see how 2020 has impacted a lot of folks. Disney Plus was introduced this year, and they're up to 73, almost 74 million subscribers, and you can just see the weight of the gravity of these numbers as all these streaming services are launching and putting pressure on the traditional platforms and delivery mechanisms. And finally, we'll end on an NFL note. For football fans out there, this is something that just kind of made me chuckle when I read about it. This is such a topsy-turvy year. and you're constantly hearing of games that are canceled or being postponed or whatever because of infection rates and having to close team facilities and stuff like that. But looking at this is kind of interesting that the Ravens have the highest incidence of players having been infected in the league, and you can see what the winning percentage is on that on that chart here. So what's interesting is that you've got some of these teams that lead the league in infection rates that are actually not playing too bad, like the Titans are fourth from the top in total in player infections, but they're still winning 73% of their games thus far, and the Ravens are winning 60%, and they've got the highest rate. Raiders are not doing too bad. Dolphins doing a little bit better than that. But anyway, just kind of chuckle. I hadn't seen these numbers. This is from DraftKings, so thought I'd pass it along, just FYI. Well, that's going to do it this week. I hope you've enjoyed these charts. Please feel free to reach out if you have any comments or questions. We'd love to hear from you. Have a safe week. Have a productive week, and we will talk to you again very soon.